Two quality stocks to buy near their 52-week low. This is a video that I've been doing every Saturday where I go through a screener and I look at stocks trading near their 52-week lows. I have some very interesting stocks today that I haven't talked about in a while, and I think they're starting to look interesting. So I really hope you enjoy it. The first one is Pepsi. Pepsi, I haven't talked about it in a while. I've been in and out of the stocks many times. The stock used to bottom around 155, 160. Then it goes up to 170, 180. Then I used to sell it and buy it back again. And it has recently broken this trend. The stock is down 3% over the last 5 years. It's really bad. As most of you know, Pepsi is not just Pepsi. So a lot of people didn't buy it because Coke tastes better than Pepsi. But it really has so many different products like Cheetos and Doritos and Lay's. And it has a lot of snacks, a lot of water brand, Lipton, some of the Starbucks beverages. They also own the rights to the Starbucks beverages. And there's so many different ones. And it's a really great company in general. And a lot of those brands are still growing organically. For example, Lay's, Cheetos, and Doritos, they're growing in double digits, which is really great. Pepsi and Gatorade, they're still growing high single digits. And they're also growing double digits in other markets such as Mexico, Brazil, and India. So that's really amazing. Now, the biggest problem with Pepsi and Coke and Mondelez and a lot of those stocks, legacy compounders, I would call them, related to the food industry, is we have a trend of people wanting to be a little bit healthier. The GLP-1 trend is a huge trend, and people are eating less, especially less sugary stuff and less snacks in general, which is waiting on volumes, and especially on soda volumes. So if we look at the volumes of shipments for Pepsi, it has declined 3% over the last quarter, 1.5%, 2%. It's been declining since September of 2022. But the company was able to offset it through price increases. Back in 2022, they raised prices 16%, 9%, 5%. They've been recently raising prices 3 to 4% to offset the effect of much lower volumes. And as you could see here, they've been able to do it. So yes, the company is declining in volume, but they have such pricing power, amazing pricing power, that they can offset it through raising prices. And not a lot of companies can afford to do that. Now, if you look at Pepsi, it's trading at about 16 times earnings. This is unheard of. The stock used to trade at 24, 25, 26 times because it's a quality bulletproof compounder. But now it's trading at 16 times earnings. And not a lot of people are excited about Pepsi. But if you're buying Pepsi, you don't only get the potential of a multiple reversion from 16 times back to potentially 20, 21 times. You also get a good dividend. The dividend has been paid for the last 53 years, no dividend cut. And they raised it at an average CAGR of 7.5%. And the dividend yield is about 4%, which is historically high for Pepsi. And it's very sustainable because the free cash flow yield is about 5.5%, and it's been growing. So the dividend is more than well covered, and the company still has extra free cash flow for them to do buybacks or to even pay down the debt. So if I want to look at my upside potential for Pepsi, I would take in the dividend, which is about 4%. I would look at the company's long-term guidance, which they have been able to achieve it so far, and it's mainly high single digits in earnings per share, which is 7 to 8% earnings per share growth. So we take in, let's say, 8% earnings per share growth, a 4% dividend. I'm getting paid 12% annually, 12% annual return with Pepsi, while I await a multiple expansion from 16 times back to 18, 19, 20 times. If the company can invest in some of the newer trend, newer brands like kind of Celsius is doing, and they can push up growth and return the declining volumes, I could easily see a reversion back to 20, 21, 22 times. And before that, I'm getting a 12% annual return for just holding a legacy company like Pepsi. So I look at those stocks for a place to park cash, for a place just to put in some money that I don't really need at the moment if I'm not finding great ideas. And I think Pepsi perfectly fits the category. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. The second stock that I haven't talked about in a while is CP Canadian Pacific Kansas City, this is an amazing, amazing company, wide moat, competitive advantage. AI is not going to disrupt it, nothing's going to disrupt it. And the stock is down over the last 5 years. It's been choppy, it goes up a lot, then it goes down. It's a very tradable stock, actually, and a lot of people have been trading it. But Canadian Pacific Kansas City has a very unique railroad. It's the only railroad company that has a straight connection from Mexico to the United States to Canada. No other company has this railroad, over 20,000 track miles. No other company can just go in and rebuild a new track and try to compete with Canadian Pacific Kansas City on the Mexican border or on the Canadian border. Now, as you could imagine, there has been a lot of reshoring coming back to the United States. And over the last year, 2 years, China used to be the largest trading partner. This is no longer the case. And now Mexico is the largest trading partner of the United States, which has been massively benefiting the structural trends around Canadian Pacific Kansas City, as they are the only one that has this railroad that goes from Mexico straight into the United States and also connected to Canada. So this is really, really important and just absolutely amazing. Now, looking at the mix of revenues, most of them come from grain, some coal, a lot of forest-related product, energy, chemical materials, metals, and minerals. Now, as you know, we've been having the trade war, and a lot of railroad companies have been getting affected by it. Now, most of the imports that are happening within Canadian Pacific are related to grain and other, really important stuff. It's not just like forest products, only like 6%. And that's been happening more in the United States recently. So it's not as dependent on exports and imports as you believe it is. A lot of it is also domestic within the United States. But despite all the trade policies that have been happening recently, CP is still growing in revenues. It's only 3%. Earnings per share was much better. They grew 12%. So it's not really as bad as a lot of people believe. The company is still putting up numbers, and they still have their long-term guidance of about double digits in earnings per share growth, which is really, really amazing. Now, looking at the valuation of CP, it's now trading at 19 times earnings. The stock used to trade at 27, 28 times. Now it's trading at 19 times. Yes, it's being affected in the near term in terms of a lot of trade policies, but over the long term, this railroad is important. We still need cheaper labor in general, and that comes from Mexico. Some products come from Canada. That's not going to change anytime soon. This railroad is not really going anywhere. And if we potentially have a change in administration, then the stock will do really well. But even if that doesn't happen, the stock is still growing 10, 11, 12% in earnings per share. 19 times earnings is not bad. But for me, for CP to get extremely, extremely interesting, like too cheap to ignore, given the underlying trade policies, it would be an amazing buy if it ever gets back to 16, 17 times earnings. If it gets to 17 times, 16 times, then it would be extremely, extremely compelling for such a trophy asset that cannot be replicated between Mexico, Canada, and the United States. And I would see around 11 to 12% of earnings per share growth. There's a 1% dividend. If I'm paying about 17 times, 16 times, then I also have the chance of a potential multiple expansion. So 16, 17 times would be around $65 to $64 per share. And it would be an amazing buy on Canadian Pacific Kansas City. And that's my opinion on CP and Pepsi. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.